Hey everyone, Coach Investor back to another earnings video for you. So we already covered Shopify and PayPal. Both of those videos will be available in the top right corner. Now with regards to Lemonade, it was a double beat, but this is not very impressive. Let's be honest, we're looking at specific metrics that we want to see improve. When you look at gross loss ratio, net loss, gross on premium, etc., etc. Unfortunately for them, there were a lot of catastrophic events, and so that impacted the gross loss ratio negatively. Overall, it was yet again an okay report. Now, just so you know, Lemonade, since the last time they reported earnings, they are up approximately 100%. Now, of course, they're down now, I think 5% or so after hours. Tomorrow, before the market opens, there is the earnings call, so things might change, and things might change throughout the day as well. On Wednesday, we had a big red day. We had that downgrade of the United States from a AAA rating to AA+. So sometimes it is company specific, sometimes it is macro. So let's jump into the Lemonade earnings report. By the way, if you want me to go over the Robinhood one, it's a pretty interesting one because they are profitable, gap profitable, but the stock is also down 6% or so. Yes, there is a decrease in monthly active users by around 1 million. And again, if you want me to cover that company, let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. I would really appreciate that. So let's start with the major highlights here. As always, in-force premium, $687 million. That's up 50% year over year. Premium per customer reached $360. That's up 24% year over year. Total customers increased 21% year over year. I think they added around 50,000 customers, so the total is now 1,906,408. And here's the big issue, I think, for the whole of Wall Street. So gross loss ratio up 8% year over year to 94%. Now, there is a reason for that. We're going to talk about that in a bit. Gross earned premium up 53% year over year to $164 million. And for the bigger picture here, they talk a bit about the reinsurance. So our 55% quota share program was re-upped and oversubscribed, with ceding commissions expected to be roughly equivalent to those under the outgoing agreements. With regards to the synthetic agents, they did a whole post about that. If you want to read it, it's going to be on the Investor Relations website. We secured customer acquisition costs, or CAC, financing designed to close the cash flow gap and unlock cash-friendly scaling. By the way, with regards to that, we actually have a nice graph which helps us understand this a bit better. So two sample spend scenarios with and without synthetic agents. So number one, without synthetic agents, Lemonade invests $100 in CAC, where LTV to CAC ratio equals 3 and payback period 24 months. Number two, with synthetic agents, Lemonade invests $150 on CAC with the same unit economics as above. And this is the result, as you can see. Without the synthetic agents, they reach $200 with $280. Now here they spend a little bit of time talking about the catastrophic events, severe storms, etc., etc. And they give us a bit more information with regards to the gross loss ratio ex-cat. So this was again in the low 70s, continuing its promising trajectory. Indeed, there were notable and significant portions of their book that demonstrated best ever results this quarter. And this is the first time we actually get those numbers in the earnings release. So our renter's gross loss ratio was below 50% for the first time, all in inclusive of cat impact. The pet gross loss ratio was in the 70s for the first time. Our homeowner's gross loss ratio excluding cat was in the 60s for the first time as well. And as for the car product, still no material improvements there. I almost forgot, I missed this when we went and talked about the synthetic agents. So with regards to rates, so California recently approved a 30% increase in the homeowners rates and a 23% increase in Lemonade Pet. Across the board, we are taking in more rates and seeing an acceleration in our rate approvals. We expect this will register on our loss ratio as new rates earn in over the coming quarters. Finally, this has taken, in my opinion, a bit too much time, but that's nothing Lemonade can do. Those are just, well, it's bureaucracy. Then with regards to preventing further gross loss ratio increases with regards to cat events, they talk here about some changes that they are making. So in related news, our team is conducting a thorough review of our book of homeowners business based on multiple factors such as predicted loss ratio, age of the home, age of the roof, predicted cat exposure, and more. As our readers will remember, with every iteration of our lifetime value model, we get notably better at predicting risk. And as our data gets more textures and refined, it's clear that our portion of book should not be renewed based on the learnings we've accumulated. Already around 2,000 homeowner policies have been non-renewed, and while actions like this slow the upward trend of metrics like annual dollar retention rate and premium per customer, they benefit our long-term profitability. This will be an ongoing process with a lagging impact, but we believe we'll see it deliver a double-digit impact on our loss ratio over the next couple of years. So right now, if we do look at ADR, I believe it's still 87%, which is the same number as last quarter, and an increase of 4 percentage points in the second quarter of 2022. So the next time we see this number go down, we already have an explanation as to why this has happened. And so revenue for the second quarter was 104.6%, increased by $54.6 million or 109% year over year. Gross profit for the second quarter was $12.1 million, increased by $800,000 or 7% as compared to the second quarter of 2022. And this is primarily due to higher earned premium offset by a higher loss ratio, which is also why adjusted gross profit is down a bit. So that was $16.6 million, a decrease of $900,000 or 5% compared to the same quarter last year. And net loss in the second quarter was $67.2 million. Yes, it's a bit of a decrease the same quarter last year. It's also a little increase quarter over quarter, but that's also primarily because of the increase in gross loss ratio. If you look at total operating expense, including net loss and loss adjusted expense in the second quarter, that increased by $7.7 million to $94.6 million compared to the $86.9 million in the same quarter last year. Of course, here the modest year-over-year increase was primarily driven by the addition of the Metro Mile expense base, not included in the prior year figure. And as for adjusted EBITDA, the loss here is $52.7 million. That's an increase of 5% year over year. But here again, this is primarily due to the loss ratio in the second quarter of this year. As for cash and investments here, they still have $941.9 million in cash equivalents, and investments. And so we've reached third quarter guidance and full year guidance. For the full year, in-force premium are a bit higher than the previous guidance, and the same goes for gross earned premium as well. As for adjusted EBITDA loss, that is also an increase from the previous guidance, but revenue is up a little bit as well. So third quarter expectations: in-force premium of between $703 and $706 million, gross earned premium of between $166 to $168 million, revenue at the midpoint of $103 million, and adjusted EBITDA loss of $50 million at the midpoint. So to conclude, while many metrics are doing fine, the main metrics that the market is probably looking at, and a lot of investors as well, rightfully so, gross loss ratio still has an extremely long way to go. Net loss, while it is improving overall, adjusted EBITDA as well, it also has a long way to go. I don't think we're going to see profitability anytime soon. But so long as we see that trajectory towards profitability, I think we'll be okay. Of course, if we again look at the graph, seeing that the stock is up 100% since the last quarter, I won't be surprised if we see a small correction in the stock price. So that will be it for this video. Of course, there will be more information available during the earnings call. The most important ones will be mentioned in the weekly Substack newsletter. It's free. Link is down in the description below. Do share your thoughts down in the comments as well. And if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.